We have Liberation Day, as you know, on April 2nd, and I'm not referring to Canada, but many countries have taken advantage of us, the likes of which nobody even thought was possible for many, many decades, And, that has to stop.
Equity markets are on track for their worst quarter since the massive COVID plunge in 2020. Uncertainty, tariffs, and inflationary pressures have dealt one blow after another to equities. On Friday, the markets erased $1.7 trillion. The Nasdaq weakened 3.2%, and the S&P 500 fell 2.4%. It looks like we will see new lows this week. Moreover, on Wednesday, President Trump is due to unleash new reciprocal tariffs that could throw the markets into chaos once again. The trade war between the major powers is therefore continuing to rage, and Donald Trump is thus sending the markets down somewhat deliberately because he needs to weaken the dollar. We look at why and what we can and cannot expect in the coming days in this video. The stock market reacted strongly late last week to President Trump's announcement that he would impose a 25% tariff on all imported vehicles and auto parts made abroad. Stock indexes plunged several percent, and the Nasdaq, for example, closed at its lowest level of the year. It has already fallen by 14.5% since the peak it reached on the 18th of February, and has thus officially entered a correction. If you recall our recent video where we talked about the similarity of the current decline to the one in 2022, mentioning that price has come back from the low made to test the 200-day moving average from which it bounced down, you will not be surprised by the current reaction. If you haven't seen the video, you can watch it in the link in the tab at the top right. Now, the space for a fall is open and price could easily get to 18,400 points, where the nearest support level is. However, it may be helped with the move by events that are definitely not passing us by this week. Yes, they are reciprocal duties, but they are not the only ones. Investors will also be keeping a close eye on Friday's unemployment data, which is expected to hold at 4.1%. You may have learned from last week's video that the Fed expects that rate to rise this year. But back to Trump. Before we get to the tariffs themselves, let's take a look at how the markets performed under his previous administration and when the United States was ruled by his party, which may reveal important insights. During President Trump's first term in the White House, the Dow Jones, S&P 500, and Nasdaq composite indices have risen by 57%, 70%, and 142% respectively. Investors are hoping that the next round of corporate tax cuts, along with the further deregulation that Trump is promising, will drive the U.S. stock market higher. What's also growing is the number of subscribers to our channel, so join in too and don't miss any more videos from the world of stock markets. But the past shows us a raised index finger. In 1913, Democrat Woodrow Wilson took office as president. Since Wilson has been in the White House, 10 Republicans have followed in his footsteps, Donald Trump being the latest so far. All 10 of these Republican presidents oversaw economic recessions during their terms in office. By comparison, 4 of the 9 Democrats who have held the presidency in the last 112 years have addressed the recession that began during their terms. The reason it pays to pay close attention to recessions is that downturns in the U.S. economy have historically not been good for corporate profits. Even though the stock market and the economy are not tied together by handcuffs, one would expect a recession to eventually weigh on corporate profits and push stocks lower. According to an analysis by Bank of America Global Research, about 2/3 of the declines in the S&P 500 occurred during the U.S. recession, not before it. And right now, the signs of a recession in the U.S. economy are growing stronger. What makes this 112-year streak so worrisome for Wall Street is the latest forecast from the Federal Reserve Bank of Atlanta's GDP Now model. The Atlanta Fed's model takes into account a range of published economic data to forecast quarterly growth or decline in gross domestic product. Roughly 2 months ago, the Atlanta Fed's forecast projected 3.9% growth for the first quarter of 2025. Since the March 26 update, the model now projects a 1.8% decline in U.S. GDP. Excluding the lockouts associated with the COVID-19 pandemic, this would represent the largest decline in U.S. GDP since the first quarter of 2009, CEI, since the Great Recession. Despite a number of worrying economic data points, such as the first significant decline in the U.S. M2 money supply since the Great Depression, and the all-time high 60-day delinquency rate for auto loans, uncertainty, mainly related to President Trump's tariffs, seems to be dominating the stock market at the moment. The president has repeatedly designated April 2nd as America's Liberation Day. A long list of reciprocal tariffs would go into effect on that day. These are essentially retaliatory tariffs against countries that responded to the first wave. Based on an analysis by Liberty Street Economics, companies that were exposed to tariffs on the Chinese market during Trump's first term fared significantly worse on the days the tariffs were announced than public companies that were not exposed to any tariffs. Particularly troubling is that Liberty Street Economics data found a correlation between these weaker stocks on the days of the tariff announcement and future poor operating results. On average, these underperforming companies will see their profits, employment, sales, and labor productivity decline between 2019 and 2021 after the US-China trade war ends. But to look at the other side of the coin, stock market cycles are not linear, which is good news for investors waiting for opportunities. Recessions often lead to higher unemployment, weaker wage growth, and poor stock market performance, but for long-term-minded investors, they just bring the biggest opportunities. Thanks to 𝗕𝗂𝗶𝚀, you too have the greatest opportunity to pick stocks like a pro and not be surprised by anything in the markets. Not only can you try the unbeatable 𝗕𝗂𝗶𝚀 Black membership for 7 days absolutely free, but it gives you access to information that covers thousands of stocks and the entire stock market. So go try it out. Stock market corrections, bear markets, and even crashes are a normal and inevitable aspect of the investment cycle. No matter what President Trump, Congress, or the Fed does, events triggered by news and investor emotions will occasionally push stocks lower. But if there is one near certainty to be found on Wall Street, it is the non-linearity of investment cycles. In short, down and up moves are anything but mirror images of each other. In June 2023, shortly after it was confirmed that the S&P 500 index was in a new bull market, analysts at Bespoke Investment Group posted a dataset on social network X that compared the length of every bull and bear market since September 1929, that is, since the start of the Great Depression. Bespoke's dataset showed significant differences in the average length of bull and bear markets. For example, the average S&P 500 bear market lasted 286 calendar days, or approximately 9.5 months. In addition, no bear market lasted longer than 630 calendar days, or approximately 21 months. On the other end of the spectrum, the average bull market in the S&P 500 lasted 1,011 calendar days, or approximately 2 years and 9 months. What's more, 14 of the 27 bull markets, including the current bull market if we bring them to the present, have lasted longer than 630 calendar days. While we can't determine in advance exactly when these declines will begin, how long they will last, or where the ultimate bottom will be, the data conclusively show that betting on bull markets and long-term stock gains is a statistically smart move. So, long-term investors need not worry too much about the current situation. You can look forward to a new video coming on Wednesday, so be sure to subscribe so you don't miss out. What about you? Are you buying, building positions, or waiting? Let's discuss it in the comments or directly on 𝗕𝗂𝗶𝚀. Good luck with your investments.